So President Trump has nominated Kevin Warsh to lead the Federal Reserve. And let me tell you, this is not just another leadership change. We're talking about a potential seismic shift in monetary policy. Today, we're going inside this Warsh Shock to build a tactical playbook for what this all means for the markets. All right, let's get straight to it. Here's how we're going to break it all down. First, we'll cover the initial shock itself. Then, we'll unpack his so-called sound money doctrine. After that, we have to talk about the huge Senate confirmation hurdle. Then, try to decode the man himself. And finally, lay out a clear playbook for managing all this uncertainty. First up, the Warsh Shock. And look, this isn't just a ripple in the market. It's a full-on shockwave. Warsh's nomination signals the most significant leadership pivot at the Fed since Jerome Powell himself took the chair back in 2017. And let's be crystal clear about this. This is so much more than a new name on the door. It represents a fundamental pivot in monetary policy. And you can bet traders are scrambling right now to price in what is a completely new reality for the U.S. economy. At the very heart of this entire policy shift is one single number, $6.5 trillion. That's the staggering size of the Fed's balance sheet. And believe me, understanding Warsh's plan to shrink it and shrink it fast is the absolute key to unlocking his entire strategy. So that leads us right to the new doctrine itself. We're likely witnessing the end of an era, the end of those post-pandemic crisis-era interventions. And in its place, the rise of a sound money doctrine built around a brand new framework that people are calling QT for cuts. This right here perfectly illustrates the core policy trade-off we're talking about. Under Powell, the Fed's playbook was to expand the balance sheet to accommodate crises. Warsh, he's expected to do the exact opposite. The plan is to accelerate quantitative tightening, or QT, which means rapidly shrinking that massive $6.5 trillion balance sheet. And the trade-off? This is being offered in direct exchange for the faster interest rate cuts that the White House really wants. So how did the market react? Well, immediately, we saw a surge in the 10-year Treasury yield. This caused what's known as a bear steepening of the yield curve. It's a really clear signal that the market is already pricing in expectations of higher growth or maybe higher inflation down the line under this new framework. But here's the thing. None of this actually becomes reality until the nomination clears a major hurdle, the Senate confirmation. And this is exactly where that tactical playbook we're building becomes absolutely critical for every trader out there. And here is the sticking point. The entire confirmation process is completely stalled. You can see it right here in this quote from Senator Thom Tillis. He has vowed to block all Fed nominations until a contentious DOJ probe into the outgoing chair, Jerome Powell, is dropped. This introduces massive timing risk, especially with Powell's term expiring on May 15th. We've got a ticking clock. And yet, despite all that political standoff, just look at the prediction markets. They're pricing in a whopping 93% probability that Warsh gets confirmed. So what's with the disconnect? Well, it seems the market is betting this is all just political theater that'll resolve itself. But that 7% chance of failure, that represents huge downside risk. If this thing drags past May 15th, we could be looking at a policy vacuum at the Fed, which could easily trigger a major risk-off event and a big spike in volatility. Okay, so with all that context, let's talk about the nominee himself. Because for traders, Kevin Warsh is a complex, almost contradictory puzzle. And frankly, it's one that's proving very difficult to solve. This brings us to the billion-dollar question, doesn't it? How do you possibly model a Fed chair who is historically known as a staunch inflation hawk, but who now seems to be aligning with an aggressive pro-growth agenda? This dual profile, this pivoting hawk persona, it makes future Fed policy incredibly difficult to forecast. It just introduces this thick layer of uncertainty, especially when you're looking out to 2026 and beyond. It makes any kind of long-term strategic positioning a real challenge. So, with all this complexity on the table, what is the tactical playbook? How should you be thinking about managing risk between now and that critical May 15th deadline? Well, the playbook starts by separating the short term from the long term. In the immediate short term, we're talking about the March FOMC meeting, the consensus is pretty clear. The Fed is likely going to hold rates and keep the status quo. But the forward guidance implied by a Warsh Fed, that's a different story. As you can see on the right, it points to volatility, accelerated QT, and a much more unpredictable environment. So to navigate this, you need to keep three key factors on your screen. Number one,
Every single headline on those Senate negotiations. 2, the shape of the yield curve. That's going to be your first indicator of shifting policy expectations. And 3, keep an eye on those prediction market odds. Any sharp drop from that 93% level would be a major, major red flag.
So, what's the bottom line here? It's this. Until the political friction in Washington is resolved, market volatility is the new normal. The initial Warsh transition trade has already boosted the dollar and hammered precious metals. You should probably expect more of this choppy price action ahead. To stay ahead of every single development in this story and everything else that's moving the markets, you can get real-time insights from our source for this analysis, FN Pulse.